So there's this rat fink of a video I keep seeing on my YouTube commercials, and it's by the taxfoundation.org. And it's a whole commercial about them breaking down exactly why big corporations, it'll like the big headlines are just sensational. They're not really looking into the practical positive effects of the fact that a large corporation in this country and many others who are very profitable every year pay $0 in taxes. That is a hot button issue right now for obvious reasons right now. And so that commercial was trying to convince us all that it's for a good reason. Listen, we have an agency here that is trying to tell you that it's not black and white, that corporations get tax loopholes because it helps them avoid spending money on taxes and instead reinvesting into the company. Actually, not reinvest into the company. They never say it like that. They always say they reinvest it into projects, things like energy, infrastructure, dance parties. I don't know. Most of the time, it is reinvested back into the company under research and development. I'm not saying for everybody, but according to the commercial, they reinvest into energy, they reinvest into infrastructure, employment, and all these things are supposed to help make our measly little tax paying lives better. Again, we need to talk about this. But first, class is in session. We have a Tale Souls Time. Corporations paying $0. A nonprofit agency is telling you that this is all the reasons why it makes sense, and you guys shouldn't be so mad about it because it's actually just logical. So again, nothing that the taxfoundation.org said was inaccurate. It's all very true. However, inside the truth is hidden like the uglier part of that truth. Those open up the possibilities, yes. But as we will see, the possibilities, are just that. They're possibilities and not factual, actual realities. So last year, Capital Group, which was a private firm and a private investment firm, they, published a report about taxes and corporations and reinvestments. They ran a report that boasted that companies like Eli Lilly, they do the GLP-1s that everyone is taking now. So they and Johnson & Johnson, which we all know, they have their hands in pretty much everything, honestly. They have both pledged 50 and 55 billion US dollars each, respectively. So 50 from Eli Lilly and 55 from Johnson & Johnson. This money is supposed to be going back to the United States of America, reinvesting into it, into manufacturing, building infrastructure for the country. The Tax Cuts and Jobs Act. So they said that because it gave them such good tax incentives and tax credits and tax breaks for corporations, it puts all that money in the realm of possibility to give back to the community. Johnson & Johnson. In February of this year, they grand revealed the plan to build a facility in Pennsylvania who has a 8.8 flat tax rate. That's planned to go down in increments until they reach 4.99%. The individual sales tax in Pennsylvania is also a flat tax rate, and it is 3% or a little above 3%. Johnson, they are going to build a facility there in the Pennsylvania, again, like I said, where the tax rate in the long term is going to be creeping all the way down to 4.99. It is currently at like 8.8 or 8.9 or something like that. And they're temporarily going to create about 4,000 jobs. Now, they don't put temporarily on the state website or in the Johnson & Johnson plan. They just say it'll create a little over 5,000 jobs. And the 5,000 jobs are going to be 4,000 on construction and about 500 jobs at the actual facility once it's open and running. And I think it's like the timeline is like 2030, 2031 or something like that. Like I said, the construction jobs, while lucrative, they are temporary. And I'm not saying that to be like, what's that point? There's plenty of point, because if paid properly, people plan for those things. They know their job. They know their industry. Construction workers, you know your industry. You're probably with the agency and you travel around doing these kinds of things because they usually, with a job this big, there's a bidding that's going to happen, and companies usually bid. Maybe the government itself, the city and stuff, will put in the bid, blah, blah, blah. They already know the deal when it comes to like pay and then the irregularity of construction work. So that's not really the main point. Is just a point I would like to point out, that in the creation of jobs, more than 3/4 of the jobs that they're quoting are temporary. So in the long run, it's not so much, they're going to pump in a lot of money in the first quarter of this long game, but after that, they're kind of just going to be raking in the bucks. They kind of, you know what I mean? They're kind of just going to keep drawing from the state constantly in terms of resources, and the tax burden is going to be shifted onto the residents and the users of their company facilities and the employees at the company, et cetera, et cetera. Anyway, so as for the jobs that will actually be on site, at the biotech facility, there's going to be about 500, they said. And my whole thing was that I suspect that they would be automated to an extent, or that they will be automating as much as possible in this facility, because Johnson & Johnson also separately stated that they plan to commit $5 million in rural America. And if you don't know anything about Pennsylvania, there are large, it's not just Philly. And it's not Scranton. It's quite a big state for East Coast size anyway. I think it's quite a big state. It's like Virginia size. Because of that, the topography changes quite a lot, even though in Maryland as well, we're kind of small, but our topography, our demography changes drastically depending on where you are. And Pennsylvania is the same. There's serious rural land in Pennsylvania. Like, it's country. Like, if you ever seen Northern Country, Pennsylvania, I think is a good place. Like, it's Appalachia. Somebody tell me what y'all say, what it's really supposed to be. People from Appalachia. Anyway, so fire from Johnson & Johnson, fire from Google, and they're coming together so that they can invest in training and AI literacy in rural areas, especially in hospitals, where they want to focus on AI database and AI administrative tasks, and like training them, the staff and everyone who works there, in AI literacy. That is what they have pledged to do. That has not begun yet, and I'm not saying it won't. I'm just saying that it hasn't happened yet. That is a lot of investment in AI. They also have a myriad of other investments that regard AI. A lot of them, they said, would be for experimenting, doing diagnosis. And Johnson & Johnson, we're just going to stay on Johnson & Johnson ass. Johnson & Johnson also opens a new facility in North Carolina. North Carolina, interestingly enough, has one of the lowest, if not the lowest, tax rate for corporations in the continental US. I want to say that's the lowest in the country, but it might not be. There might be other states where like they literally don't pay, because according to the maps that I've seen, including one on taxfoundation.org, they have some states grayed out. So there's neither no data or they don't pay corporate taxes there. That's the pledge. They said they were going to do this, manufacturing, bringing it on home to America, which is great because, one, the $55 billion is no small change, right? It is a drop in the bucket when you realize how much they make every year. Johnson & Johnson, for example, they had an increase in sales of 6%, and that brought them to an annual revenue of $53 billion. And that is only domestically. If you don't know, Johnson & Johnson is an international company. Globally, they made over $93 billion US. Let's cut out all the international stuff, because they probably have things they need to do with the international money, right? $53 billion this year. What they made before they took any money for anything else. That's just the money straight that came in. Let's go with that. So let's just say they have to still pay bills out of this $93 billion. And let's say we're going to cut out the international portion. Economically or financially or accountingly, it makes sense that they would stretch it out over the next 4 years, which they said, because everything's supposed to be 2030, 2031. So 4 to 5 years. We're just going to go with the lower number. Honestly, we're going to say 4. Do you know what 55 billion is stretched out over 4 years? 13.75. So they would roughly be spending 13, the goal, if they want to meet their goal by the end of the year, if they want to do it evenly, they could do small here and then really big one year. But I'm just saying, if we split it up evenly, they're at 13.75 billion US dollars every year spent on this pledge. They have promised out loud, but there really isn't anybody to hold their feet to the fire. Do you know what a modest 20% tax rate would be if they tax straight revenue, which they don't usually tax straight revenue? There is a certain amount that is taxable, but let's just say the whole shebang was taxable. Let's just say 53 billion of those domestic only dollars was all taxable, 100% taxable. If we put them at a 20% flat tax rate, it would be $10.6 billion. So if you're already planning to spend more than even the increased flat tax rate would be, why won't you just commit? Editing me here, I thought I would add the fact that I went ahead and did the actual math for the actual net income so that I could do like a rough estimate on what the corporate income tax would be. So they actually did $26 billion in net income. So that means after taxes, after depreciation costs, after operation costs. P.S. Their operation costs are consistently on their neck. Like, they're neck and neck with revenue, so there isn't a lot of wiggle room there. Like, free cash flow is kind of limited at Johnson & Johnson. Not to an extreme that it would hurt their business, but it is tight. Anyway, the same 20% that I proposed as an egregious like tax hike for flat tax, corporate tax, 20% on that. In the state that they file, it is a flat tax rate. Some corporate tax, some states have tiered corporate tax rates, but I'll talk about that later. The difference between tiered and flat. New Jersey is a flat corporate tax rate, and it is like 9%. So even if we moved it to 20% for their filing in New Jersey, off of that 26 straight net income, it would be $5.2 billion, which is what they were paying anyway. But I have some questions. Keep in mind also that companies don't pay just income tax. They also pay, sorry, I'm looking at myself as I look crazy. So they pay state taxes. They might get credit for like property tax. I don't know if corporations pay that much in property taxes. That might be one of the tax incentives that they have with the state, because some individuals also get property tax like credits and stuff for your taxes, so that also brings down the taxable income. It's a whole other story. You talk to your tax professional about that. I am not that. So they pay like Social Security tax, the Medicare tax, healthcare tax, but they also again get credits for healthcare packages when they give them to you. You get tax credits for that as well. So, but there is a lot of other taxes, and I'm only talking in this video about income tax. But there are other taxes that corporations need to pay. And so hearing that they've only paid about a little over $5 billion in taxes last year, it just sounds like the math don't add up. Because like I said, if we increase the flat tax rate that they pay in Jersey to 20%, it's 5.2 out of that 26 net income. That's straight income tax. Period is 5.2 billion. And you're telling me in taxes, period, they pay like a little over 5 billion. So I'm like, how much in tax credits is happening here? And is it so that they are, can you really just not afford a higher tax rate to help shoulder some of this tax burden? But anyway, back to the video. If you have to go through this rigmarole to commit to $55 billion over the course of 4 years, again, and then you'd rather do that than just pay a higher flat tax rate period across the board. I can only assume it's because you do not actually plan to keep said pledge, or you want to give because it comes with all those tax credits that help lower your taxable income, or corporations hate the idea of having a mandatory bill that eats away at the reinvestment, which, like I said before, it seems to be businessese for like profit laundering. Reinvestment is a vital Reinvestment is a vital portion. Also, I want to say portion and part. Reinvestment is a vital portion of doing business. There is a certain amount of money you do want to be able to reinvest back into your business to be able to not pay bills, but to actually further the business, make a savings plan, have some sort of free cash flow for other things, a little financial liquidity, asset purchase, stuff like that, more development stuff, all these things. Very normal, very normal. Reinvestment, the goal is to be able to reinvest into your own company beyond just making enough money back to pay your bills. Okay. I am just saying, like, sometimes it feels like profit laundering with a lot of these companies that in excess, like, it's just not, nothing doesn't seem to be proportionate with what's going out. Things coming in, it just seems like they're coming in tenfold, but then they are going out in a trickle. It just makes me wonder. In my opinion, it's just like, why don't you just pay your damn tax bill? Just pay your damn tax bill and have one less variable bill. You have this flat tax rate. It can go up and down depending on how much money you've made that year, but technically, like, it's going to be 20% no matter what. You know what I'm saying? And then you don't have to make these weird pledges, except this is the loophole. Because also, when a corporation gives money and makes it seem like it's some sort of charity or reinvestment into some infrastructure, you get more tax credits for that. So even out of the money they're pledging to the country, they get a cut of said money just by saying they're going to spend it. So it's in their best interest to spend the money because they get credited for spending said money. Unlike with taxes, where you just pay it and it gives back to the people around you, into the community around you. It doesn't give back directly to you, but you benefit because of the community that gets uplifted when you're in it. Speaking of in the community, the states also help with this infrastructure. So I'm not sure how they do the split, how much gets paid for who and to do what. But the $1 billion that they spent in Pennsylvania is going to be matched with Pennsylvania's own $41.5 million in actual, like, infrastructure help. So, like, there's money again that they're going to be getting to come build this business in Pennsylvania, because Pennsylvania says it's going to bring more money to the state, and it will bring a certain amount of money to the state, especially to the area. North Carolina putting up $12 million and an expected grant. They didn't put an exact amount. Is going to help with that, whatever they're going to be doing down there with that plant. So again, they're going to go to another state with a low tax rate already. Pennsylvania's is going to become low, so they're playing the long game over there, but they have all those incentives. They're $41.5 million of incentives to come there. North Carolina is putting up $12 million, but I feel like they could put up a little less money because they're not taxing them as much in the beginning. Pennsylvania will now be taxing them about 8.8 or 8.9%. On paper, they probably were like, well, we don't have to give you as much credits, and then we're also going to go in this fund. It's like a grant, and we're going to be giving you free money again. So why do we have to give you? We don't have to give you that much. In case anybody was wondering, when I'm saying flat tax rate, I do say that because there is a difference between, I can't remember the name, but I'm just going to say a tiered tax rate and a flat tax rate. Say you $80,000 a year, and the tax brackets just go by number, and like it's like from 0 to the poverty line or whatever, and then from the poverty line to another step, and then another step to another step. So I'm just going to break it up. So we're going to go 0 to 24,000, 24,999, right? And then it's 25,000 to 75,000. 74,999, and then 75,000 to 100,000. or damn it, I keep doing that. 75,000 to 9,999, right? And then 100,000, and then it goes. When you have an individual tax rate that is a flat tax rate, it means everybody is getting taxed 8.7%, period. Whether you're making 300,000 or you've made 30,000. The reason why individuals do not prefer a flat tax rate for individuals and prefer for a company, because or a corporation, I should say, it seems inequitable. It seems like somebody is taking more burden when it comes to taxes than somebody else, simply because 8.8% out of somebody who makes $1,500 a month, a lot more than 8.8% out of someone who is making $12,000 a month, or even someone who is making $4,000 a month. Yes, that is a lot more out of their check dollar wise, but the effect of said subtraction is completely disproportionate. Even though it is the same, it is not an equitable treatment of personal taxes. Now, tiered taxes, however, feel more equitable to people because it takes into account where you are and how much you are making. So if you're under a certain level of the poverty line, you really don't pay income tax. You pay it mandatorily, but you know what I'm saying, you usually don't owe much after that, and you might get a refund, but I'm not a tax law expert. Please talk to a professional. I'm giving examples. These aren't the actual standard rates, but there is a certain point where you do not have to file because you haven't made enough money. But under a flat tax rate, you are paying. But anyway, under this, you don't pay at all. And then if you get to the, in our example, 25,000 to 74,999, you would pay something like 3.5%. 75,000 to 100,000, which is where you are. Remember at the beginning of this, I said pretend we make $80,000 a year. And 75,000 to $99,999, that tax range we'll say is at 8.7. Because of this, most people think, oh my God, it's 80,000. I can't believe I'm about to get taxed 8.7 in tiered tax form. That's not how it works. To put it plainly, the best way I have understood it these years is that each block gets taxed in its rate. So your first $25,000 doesn't get taxed. Then that bracket there, the 25 to 74, that gets taxed at 3%. And then anything after that 75,000, that also gets taxed a separate thing. And in this case, it would be the 8.8%. So that, what, 5,000, you make $80,000. So you have about $5,000 in that bracket. According to our tiers, you have $5,000 in that bracket. That $5,000 is the only thing that will get taxed 8.7. You have the other set of money that's getting taxed 3.7, and the other set of money that's not getting taxed at all. So anyway, that's the video for today. Today was about taxes. Just started this new series. This series is called Follow the Money, as you saw in the title. And I just wanted to do some thinking out loud, some presentation of some information to you guys. And since it's tax season, I thought, why not talk about this? Thanks for watching. I hope you come back. Bye.
Do you still love me or not? I need 7 outside.